we start, definitely we need to introduce our speaker for the day. So our speaker for today is CY Saw Chuan Yen, well known as CY Saw. He's the lead trainer for Excellent, and he's also the Chartered Market Technician Chartered Holder, CMT. So today's topic is definitely his forte, and he's also a certified master trainer of neuro-linguistic programming and certified HRDF trainer. Now, besides that, he's also a performance coach with extensive experience in coaching individuals with performance improvement, behavioral change, self-empowerment, and personal breakthroughs. His specialties is in training system and strategies, training psychology, NLP, and coaching. Now, without further ado, please allow me to pass it over to you, CY.
All right. Hi. Good evening, everyone. How are you doing? I hope everything is doing well as well as fine on your side. So today's topic is about modern technical analysis in the new era. It's about technical analysis, but more specifically, it's about the modern technical analysis. Now, I believe many of you who are just getting started in trading, probably the first thing you learn and get in touch is about learning how to read charts, learning how to use indicators. So all of those things are technical analysis. Am I right? And because of the popularity of the usage in technical analysis, you may also see a lot of trainers and speakers speak about this. So for you, when you get started in trading, technical analysis for you is just technical analysis. It's a new thing for you. However, do you know that there are classical technical analysis, which is the old school of technical analysis, and there are also modern technical analysis. Now, for this modern technical analysis, I wouldn't say it is a new school, but because of the technological advances, we can do even more things with technical analysis way beyond the classical technical analysis. Many people are still, in fact, are learning and still using the classical technical analysis, the old method of trading. So I would say more than 90% of the people, maybe more than 90% of you, are still using classical technical analysis in your trading. So you must be wondering, what are the differences between technical analysis for the classical as well compared to the modern technical analysis? And most importantly, you need to understand what are the advantages and disadvantages of technical analysis. Now, a lot of speakers have unintentionally mystified the usage of technical analysis, that you may have a misunderstanding or misperception that technical analysis can do everything. Technical analysis can trade every products in every market. So those are just partially true only. It is just partially correct. All right. And because technical analysis itself, it has its own strength, it has its own weaknesses that you need to understand when you use them. So that's what I will be covering and share with you today, so that you have a clearer and broader view about what technical analysis is. And by the end of this session, you will understand the overall concepts about the differences between classical and modern technical analysis. And towards the end of the topic, I am going to share with you some ideas how you can achieve consistent results in trading using the modern technical analysis. So are you ready? So if you're ready, type in OK or click on any emoji or emoticon, and let's get started. Now, a quick disclaimer that, of course, this session is for general information only. It's a very standard one. You can give you 3 seconds to look through it. 1, 2, and 3. Now, I believe Ting Ting have already introduced me. My name is CY, and let's directly jump into the main topic on today's. So today we will be looking at what are the distinctions between Western TA as well as Eastern TA. So I am going to put this into 4 topics. So the first topic is the distinction between Western TA and Eastern TA. I believe many of you did not know about this, and how come there is Western TA and Eastern TA. Here I will be explaining to you what both are the differences. Both of them completely have different philosophies as well as a thinking process when it comes to trading. And topic number 2, the difference between classical TA and modern TA. This one is very, very important for you to understand, because there is a huge differences when it comes to application in terms of trading when you use classical technical analysis as compared to the modern technical analysis. A lot of people are not aware of the differences. That is why when they apply technical analysis in trading, they are unable to get consistent positive results, but they are able to definitely get consistent negative results over time. So maybe that is something that sounds or even seems familiar to you already. And the third topic, I am going to share with you what are the misconceptions and limitations of technical analysis. So this is where a lot of people buy into the idea of technical analysis that can trade every product or every market. So here there are many misconceptions that you need to clear off so that you can have a clearer picture and understanding about technical analysis and how you can benefit from using technical analysis. And lastly, topic number 4, how to achieve consistent results in trading. Remember earlier that I mentioned many people they are able to generate consistent results, but those are negative consistent results. And you definitely do not want to get negative results, am I right? Because all of us, we definitely, when it comes to trading, we expect to get positive results out from trading as well as investing. So in topic 4, I'm going to share with you a general trading philosophies where I strongly believe you should put more focus and attention to in trading, where you should focus on in terms of developing your trading strategies and systems rather than just focusing on technical analysis. So let's quickly go into the first topic. What are the distinctions between Western TA and Eastern TA? So some of the differences you may already know it, whereas some of the differences I'm going to cover a little bit more in depth so you can understand how come there are differences in Western TA as well as the Eastern TA. There are differences in both trading philosophies as well as their thinking in it. Now, the first one, let's look through what is the first major differences. Of course, for Western TA, the differences is of course in the terms of the chart, what you see from the chart. So for Western technical analysis, which is bar chart, Eastern technical analysis, which is the candlestick chart. Now, some of you might be surprised with the Western TA because of the bar charts. And what bar charts am I talking about? So let's have a quick look about what is actually bar chart. So on the left-hand side is the bar chart, right-hand side is the candlestick. So bar chart would look something like this. So for some of you, you may have not seen bar chart before. So it is quite similar as the candlestick chart. So here, the high and low price are the same. The opening price for Western bar chart is actually labeled on the left-hand side, and the right-hand side is actually labeling the closing price. So for both bar chart and candlestick chart, they actually represent the same information. The difference is how it is being drawn on your charts. Now, similarly, for a down day, your bar chart and candlestick chart will look the same thing as well. A bar chart left-hand side is actually your opening price. A right-hand side is actually your closing price. So your high and low remains the same. So this is generally the differences between bar chart and as well as candlestick chart. So let me give you a quick overview about the differences in terms of a bigger picture for both Western bar chart and candlestick chart. Now here you can see both are actually giving you and telling you the same information. And of course, you can customize both bar chart and candlestick chart in different colors in your charting software or platform. You can customize it as green and red, black or white, or any color combinations. Now, a question for you. How many of you here use bar chart to trade? Can you type into the comment box to put I in the comment box? How many of you actually use bar chart to trade in your trading? I would like to know how many of you it is still young in the market or relatively quite some time in the market already. So I guess most of you never seen bar chart before, right? Or maybe somewhere along the line when you get your charting software, you play around on the differences in terms of chart. So bar chart is something that you have not seen before. So if you read technical analysis books that is published before year 2000, most of the examples from those technical analysis books, right, they will be actually giving examples in terms of a bar chart. So hardly you will see candlestick chart books that are published before year 2000. And for charting platforms, before year 2005, majority of the charting platform, the default chart is actually using bar chart. So if you are starting your trading very early, definitely you've seen bar chart before, because the first chart that you see in your charting platform is actually bar chart. So starting around year 2010, there will be more charting platforms. You will notice more charting platforms. The default chart, they have actually switched to the candlestick chart as your default. So this is where why the popularity has been gaining in terms of the Eastern candlestick chart. Now, the main thing is this. This does not mean that a bar chart is not useful in trading. Okay, bar chart is still very, very useful in trading because, you know, in the olden days, a lot of people still using bar chart. Of course, for you, many of you are still relatively new in trading. You started with a candlestick chart, but both of them is still, you know, still applying and showing the same information. The most important thing is not about which chart you use. It's about the strategies on how you trade the market. And I believe many of you using candlestick chart patterns to trade nowadays, right? However, bar chart itself, it has also its own bar chart patterns to trade. So some of the patterns for both bar chart and candlestick chart, they have similarities. So if you are interested in bar chart trading strategies, you can actually read those olden days, the old version of technical analysis book. Now, we have already gone through the first main differences, which is on the chart method. Now, the second difference from Western technical analysis is actually on the technical indicators. In fact, majority of the indicators are actually developed in the Western world. Using mathematics or quantitative methods analysis to build their indicators. And most importantly, a lot of the indicators can be actually do back testing. It can be back tested. In other words, your strategies from our using Western technical analysis, you can test your strategy before you even use it. Now, let's look at what are the differences between Eastern technical analysis. Now, listen to this very carefully. There are a lot of differences here. Probably you may heard of it, but let me highlight to you what are the main differences. So on charting, there are definitely difference. And of course, for technical indicators, most of the Eastern technical analysis, we are still actually using Western technical indicators, and then we customize from it. So although there may be a lot of personalized Eastern technical indicators, but they are not as popular as those Western technical indicators that gains international recognition and popularity. Only some of the notable indicators are really well known, especially on the candlestick patterns. Now, the challenge for Eastern technical analysis is that it would be hard to backtest it. So for example, if you want to backtest your candlestick strategy, not all candlestick patterns can be backtested. Only some of the notable candlestick patterns can be backtested only. So here we can see that in terms of Eastern technical analysis, there are still limitations in it. And many of the candlestick patterns cannot be backtested. And another concept that you would need to know from Eastern technical analysis, which is this, which is the additional concept, which is very, very, especially coming from the Chinese community. Now, Chinese community, I'm not referring to just Malaysia Chinese community, okay? It is also coming from, China Chinese as well as Taiwanese Chinese community. They have this additional concept regarding, they have their own perception on technical analysis. So for example, they may have fancy names on trading strategies. So for example, in Western technical analysis, you have multiple moving average strategies, right? So the Chinese community, they may create a lot of fancy name that, it may get you confused about, what strategy it is. And the second concept is that on Eastern technical analysis, they have this thing they would call, you might be familiar of, which is they create a story out from the market, which they call it, the big players is controlling the market, the big players is manipulating the market, the bankers, the syndicates, the Goring group. So all of these are actually just fictional characters. Those characters are hard to be proved to be true. Okay, it is just only fictional characters. It is just only a story that is created out to explain what is happening in the market. So this is where if you have the concept of big players or syndicate, so this is where it leads to another concept where you will see market as if there are people push the price up or force the price coming down. Am I right? So these are the things that you will be seeing from the Chinese community. So of course we are in Malaysia, right? So we might be a little bit influenced in these terms of concept. And of course, when you trade, it would be best for you not to have this concept at all. You don't need to learn this concept or understand this concept, because in the Western technical analysis world, we don't have this additional concept. And for the Western world, they don't need all of this concept also. Why? It's because when you have all of these additional concept, it will gives you a subjective interpretation. And when it comes to application in your trading, you would have a lot of lack of consistency when you apply it into your trading. And besides, it is just only fictional characters, right? It cannot be proved. So all of these concepts does not exist in the Western world, and English books also don't use any of these things to describe technical analysis. So in fact, if you were to learn technical analysis, I would highly suggest you to drop off this additional concept, because it does not actually help your trading as well. And one more thing that I will highlight is that, especially a quick suggestion for you, that for those of you who like to read books, for those of you who only read English books, you won't face with this additional misconception from the Eastern technical analysis, these concepts. Okay, for those of you who read English books, you are safe. Whereas for those of you who can read Chinese books, okay, you might be a little bit facing a bit difficulties, because if you want to avoid all of these fancy concept, right, you should actually go for those translated materials, which is English books that is translated to Mandarin, or that would be free from all of these fancy concept. Okay, or you can also avoid reading books that is directly from Chinese author, because books that are directly from Chinese author, they may add all these concept into your trading. So when you have all of these concept in your trading, it would be a little bit hard for you to make progress in trading, because whatever things that happens in the market, you would tend to blame the price movement onto big players, the bankers, the syndicates. This is where you are starting to push away your responsibility as well as your accountability for your own trading results. Okay, so this is actually already developing a poor trading psychology that is not going to help you to improve your trading development as an investor and trader. Okay, so these are the main differences between Western technical analysis and Eastern technical analysis. Now, let's have a look on the second topic, which is what are the differences between classical technical analysis and modern technical analysis. Now, pay attention to this, because I believe many of you are still using classical technical analysis. And I'm going to share with you what are the major differences in terms of application for both classical and modern technical analysis. One of them has a consistency in application, while the other one of it has a it has lack of consistency. So later on, I will give you some examples so that you can understand what are the differences clearly. Now, let's go through the first technical analysis, which is the classical TA. So of course, as the name suggests, classical means the old school. For example, like classical musics like Beethoven, Mozart, Baroque. So those are what we call the classical stuff, the very old stuff. And of course, classical, it has its advantages as well as disadvantages. So on classical technical analysis, it started with a trend line first. It started with, as long as you have a ruler, you can trade and find good trading opportunities from the market. So this is where, how those market technicians or technical analysis in the early days, we call it chartists in the early days, they tend to use ruler to make money from the market. So this is where they found out they can use trend lines, support and resistance lines to trade the market. So after they have these two trend line and support and resistance line, that is where they further develop their trading method into looking charting patterns. Okay, so later on I'm going to share with you what are those common chart patterns. And of course, for classical technical analysis, if you do all of these things, it is because it is drawing, right? You have to draw it by hand. So of course, when it comes to drawing, there will be a lot of subjectivity in terms of drawing, and your interpretation might be subjective as well, because not everyone would draw out the same thing. Different people would draw the same market very, very differently. So let's go through a quick example so that you understand what I actually mean by that. Now here, let's look at the chart patterns first. So for example, we have a reversal pattern. For example, like double top, head and shoulders, bottom as double bottom, reversal, inverse head and shoulders. We have continuation patterns, which is the wedges or even triangles. We have also other neutral continuation patterns as well, where it can actually go both ways. So all of this requires for you to draw. And of course, in real life and in actual practice, it is really, really not easy to draw and identify all of these patterns, because if you were to look at books or standard textbook, they will give you all of these patterns like you can see from this slide. But when it comes to application, you are not able to find this fixed or very standard pattern, because in actual real life, there are not every products have this kind of perfect patterns. And in actual practice, the actual price patterns may be run out a little bit. So that is why when it comes to application, it is not easy for you to apply with consistency. And most of the time, after price happens already, after the whole pattern has already formed, then only you can see the pattern clearly. So before the pattern is formed, it would be hard for you to identify. Now let's have a quick run through on a quick example here. Now this is a typical candlestick chart, which is the FCBO market. So let's say we look at the challenges in terms of drawing trend line. Now, of course, when it comes to drawing trend line, I believe a lot of you, have know how to draw trend line already, but I'm not going to teach you how to draw trend line. But I would like to highlight out why is it trend line sometimes can be subjective when it comes to a drawing and application. So here we have a trend line, which I label it as A1, and another trend line, which is trend line A2. Now, can you tell me which of these trend line will you be actually drawing in your trading? Okay, my question is, I repeat my question, which of these trend line will you be drawing? Is it A1 or A2? You can type your answer in the chat box below. Are you going to draw A1 or will you be actually drawing A2? So most of you, some of you put A1, some of you put A2. Okay, depending on how you learn your technical analysis and who you learn from. In fact, both A1 and A2 both of them correct, and both of them I cannot prove them to be wrong. Okay, both are actually correct. And which of them is actually correct for you is depends on how you actually look at the market. And why they are here from the chat box alone, you can see that how come there are two different parties that actually do, would draw the market very differently. Some people would draw A1 line, some people would draw A2 line. And of course, if you draw your line differently, correct, the timing for the downtrend would be actually very, very different, because your downtrend of interpretation is as long as the price is not on the line, which is when your price is actually below your uptrend line, it is considered as downtrend, right? So if you draw A1 and A2, your timing for downtrend would be very, very different. And of course, your exit timing would be very different as well. So the next question for you is, this one you think for yourself. Are you actually satisfied with your current method of analysis and exit point? Okay, regardless of which line you draw, A1 or A2, are you satisfied with your method of analysis as well as your exit point? And this is the major thing in trading, because I believe a lot of you knows technical analysis, learn technical analysis, maybe have attended many seminars or courses on technical analysis, but when it comes to drawing line, when it comes to finding tools as well as strategies, you might not be satisfied with it. But in fact, later on, and when we go up to topic number 4, you understand why I would say technical analysis is just only a tool. Whichever tool that you draw, you need to be acknowledge the strength and weaknesses in it. Okay. Now another quick example, which is another line that you can draw here, which is here. Here we can draw B1, and of course another one we can draw B2. Which of these line are you going to draw? Are you going to draw B1 line, or are you going to draw B2 line? Let me know in the chat box below. How are you going to draw this particular line? So most of you would draw B1 line, right? Because it haven't happened. But after it happened, maybe you will want to switch your line to B2 already. So this is why we can see drawing trend line itself, there are challenges. So this is actually one of the challenge in classical technical analysis. And let's go through another quick challenges in terms of drawing support as well as resistance line. So let's look at the sideways period, and we draw a support line first in this chart. So here we can draw a support line 1, we can draw a support line 2, we can draw a support line 3. So I believe most of you who learn technical analysis before, you would agree either one of these lines you can agree with, while the other lines, support line, you might not be able to draw out. So in fact, all of these 3 lines are actually correct, because it is depending on what is the reason you draw for that particular line, and whether you are comfortable with that particular support line or not when you trade. And another example, let's look at the resistance line. We can draw resistance line 1. We can also draw another resistance line 2. So when it comes to different resistance line, your entry method for, let's say, going for an uptrend entry, your entry would be very, very different as well. You may be using R1, your entry would be any price above R1. If you use R2, you will enter when the price is above R2. So this is where you need to acknowledge the differences in classical technical analysis. It has its own weaknesses. The most important thing is that you need to be comfortable with it. Now, another example, which is on recognizing chart patterns. So let's look at this same chart. Now, are you able to see what is this chart pattern or not? For those of you who learn technical analysis, I give you a quick 10 minutes to identify what pattern is this. So some of you, if you draw this according to technical analysis, you may say it is a triangle. It may be a symmetrical triangle or ascending triangle, right? So you can agree with this, right? Triangle. But however, if we look a little bit forward, right, it may not be necessarily be triangle anymore. So you need to go back to the very theory of technical analysis, whether is this actually a valid or a qualified a triangle or not. Okay, there are criteria for a lot of minor as well as a detailed criteria for you to draw all of these patterns. Another example on price patterns. Now, from same chart, earlier we have seen triangle. Now, for the same chart, are you able to see there is a head and shoulder from this chart or not? Now, look carefully on this line. So if you were to look at this chart this way, you may also come up with a head and shoulder, or you maybe misinterpret this as head and shoulder. But in fact, in actual technical analysis, this is not a qualified head and shoulder. But if your technical analysis, when you learn it, is not detailed enough, you may misidentify this as a head and shoulder or a triple top. Okay, I like your question. Another example, same thing, also same chart. You may also identify this pattern as head and shoulder as well, because there is one peak and there is another two peak. Left hand side, right hand side peak is actually lower than your head. So this is you may be able to identify this as a head and shoulder as well. In fact, this is actually not a qualified head and shoulder. Okay, head and shoulder has a very specific criteria out from it. Okay, so in short, here I would like to highlight out in terms of classical technical analysis is that there are a lot of subjective interpretations, especially if you learn it incorrectly or if your criteria is not strict enough or not detailed enough. So when you apply classical technical analysis in your trading, you might draw it wrongly, and then that is where you may have a wrong interpretation or misinterpret the market. You may also see patterns when there is no pattern at all. Okay, I repeat that. You may also see patterns in price chart when there is no pattern at all, zero pattern. So earlier from this same chart, you can see head and shoulder, you can see ascending triangle, you can see rectangle, you can also see a triple top, for example. So there are so many ways of interpreting a specific and particular chart. So this is where you can see that this is why you always unable to get a consistent positive result. The positive result that you get is actually inconsistent. So it basically comes from your inconsistent in your drawing and your interpretation, and therefore your inconsistency in your decision making, and your results would be inconsistent as well. So far can follow? I repeat again. Why do you get inconsistent result? It is because it is starting from your inconsistency from your drawing, inconsistency from your interpretation, and then when it comes to decision making, you would be having inconsistency in decision making. So which is why your trading result would be inconsistent as well. Can follow? Okay, if you can follow, give me a thumbs up or put an okay in the chat box so that I know you understand this concept clearly before we move into the modern technical analysis. You need to understand this concept. What do we mean by consistency in trading? It is starting from your interpretation, and then your decision making needs to be consistent. Then your result only can be consistent. Okay. Now, great. A lot of you understand. Now, let's move on into the modern technical analysis. Now, for modern technical analysis, of course, we have technical indicators, which is developed for majority from the Western technical analysis. Of course, from the technical indicators, most of the technical indicators are developed by starting from mathematics or quantitative model. So which is why it is quantifiable, because it is a go through by mathematics or even statistics. And you can also backtest your technical indicators. And this is where, of course, when you use technical indicators, modern technical analysis, it is objective for you in terms of drawing and interpretation. Why objective drawing? Because you don't have to draw at all, right? All you need to do is, in fact, you just need to plug and play your indicator only, because most charting platform has their own built-in indicator. All you need to do is just plug and play. And the challenge here is this. Later, I'm going to share with you the major challenge in modern technical analysis. Most of you would apply it in a very different way. Now, let's go through a very quick example on modern technical analysis. So here, this is where a normal typical chart, right? And when you add a technical indicator comes in, and why technical indicators? Because in the olden days, because of the advances of technology, it's not so advanced, right? Computer is also not so advanced. So you need to calculate all of these indicators, for example, moving average every single day. And of course, luckily nowadays, we are living in the modern technology era, and we don't need to do manual calculation. All of your charting software calculate your technical indicators automatically. All you need to do is just to insert the indicators you want, then the line would comes up in your chart. You don't need to draw this for yourself. So for example, in this chart, it is one of the indicator, moving average. This is, of course, one of the most, probably is the earliest indicator when it comes to technical analysis. And it gives you a clear interpretation of an uptrend and downtrend. So for example, here we can see that when the price is above the moving average line, we call it an uptrend. When the price is below the moving average line, it is considered as a downtrend. Okay, so because the moving average is calculated based on mathematics, it is a fixed formula. So everyone will actually be getting the same answer. All right, and of course, depending on which parameter or moving average day that you use. So let's have a quick look about the simple moving average trading rule. So on the first left-hand side circle, this is where you can see when the price is above the moving average, it is an uptrend. So you may take a long or a buy position. And on the middle one, you can see when the price crosses below your moving average, it is considered as downtrend. You would take a short position. Very simple, right? And let's go through another quick example. Here again, when your price is above your moving average, you are having a long position. And when the price is below your moving average, you take a short position. So although this sounds simple, but later on, I will let you see how come a lot of people apply it very, very differently. Now, many people, although I believe you use modern technical analysis also, right? You use technical indicators, but you use it a very, very subjective way, just like how you use classical technical analysis. This is where, a lot of people out there, they are still using classical technical analysis of method, the approach to trade the market, which is very highly subjective. Okay, so most people still use modern technical analysis very, very subjectively. So we go through the same chart, the same moving average parameter, but let's see what are the subjectivity that I'm actually referring to. Now let's go through on the first circle where this is actually the actual entry point. All right, when the price is above your moving average, you may take a long position, you long the market. However, let's say, for example, if you miss this particular signal or this trigger day, what are you going to do? Let me know what are you going to do if you miss this particular trigger or a signal day. What are you going to do next? How are you going to find your next trading opportunity from the market? So I believe most of you would, that is where you would begin to bring in subjectivity into your trading already. So this is where you use the modern tools in an old way. So some of you will put, you wait for, it comes back to MA. Some of you would use support and resistance line or adjust your moving average. Now, let me give you a quick strategy. This is one of the very common technique. It is called moving average bounce, or in other words, we call it the MA bounce, because your moving average can be also serve as a support and resistance line. All right. So let's say if you were to miss this particular trading day, then next you would be finding as long as the price comes near to the moving average, then this is where you would find an opportunity to enter the market again. Okay, this is one of many techniques which is called the MA bounce, the bouncing technique. Like how you would apply the support and resistance line. When the price comes near to the support, you take the risk to enter the market again. And another time, if you, let's say, miss the second trade, you might attempt to go for the third trade. Now, of course, some of you may have a question is that some of you, right, when it comes to the second trade, this opportunity, right, it is a down day, right? Because you can see that there is a big red candle, and although the price comes near to the moving average, it is actually a down day. A lot of you might, what we call in trading is that we may be chicken out, or we do not have the courage to actually pull the trigger to enter the market again. And next, when we have another opportunity to enter the market again, then when the price comes near to the moving average, that is where, if you were to use the MA bounce technique, it is actually another opportunity for you to enter. However, a lot of people, you may not want to enter already, because you might be afraid what happens if, let's say, the price cross down the moving average. So this is where you can see that there are a lot of subjective interpretation. Can you see that? And there are subjectivity also comes here, is that how are you going to define when the price comes near to the moving average line? How near is considered as near? Okay, would you define near? How near is actually near? And if it is really when the price comes near to the moving average, do you dare to make that entry every single time or not? So here you can see that you are unable to make the same consistent interpretation every time. And then this is where you are unable to make the same consistent trading decisions over time. So your trading results would not be having consistent also. Okay. So another same example on the middle part is that, let's say this is actually an entry point. If you miss it, you might be finding another opportunity when the price comes near to the moving average line. And if you miss this, are you willing to take the opportunity for the second time, or the third time, or maybe the fourth time? Okay, so this is a lot of interpretation here. So this is where, although you use modern technical tools, but your application is actually the classical method. So this is where we can see that there are a lot of inconsistency. So same thing on the far right hand side as well. We can see if you miss this one, are you going to take this trade, or this trade, or this particular trade? Okay, when the price comes near to the moving average, it is very, very hard for us to define it when it comes near to the line. Okay, now there are other forms of modern technical analysis, which is on the quantitative analysis. So of course, a lot of people, you would say that, quantitative analysis might seems to be a very complicated analysis in terms of trading, but in fact, it's not. Technical analysis itself, especially on the modern technical tools, they themselves is actually a quantitative tools. Okay, moving average is actually based on mathematics, statistics. It is based on quantitative analysis. Your MACD, your RSI, your stochastics, all of them are actually quantitative analysis itself already. The challenge is that when you apply these quantitative tools, you apply it using the subjective method to apply your in terms of your trading. There are other quantitative analysis where you can actually do your research on the fundamental factors, for example, economic data, or any other fundamental data. You can also using quantitative analysis to test on what are other factors that can actually affect the market. For example, you can do a research on how does the moon affect the market is going up or going down. Whether does the weather, okay, whether sunny day or rainy day is going to affect the market or not. And you can also analyze on news, which is actually, this is most, very, very advanced and sophisticated quantitative analysis, where they actually using the natural language processing method linguistic analysis in terms of news. So they analyze on language to see what is the sentiment of the market. So this is a lot of quantitative analysis here. You once you use quantitative analysis, you can further develop into algorithm trading and intermarket analysis. Now, intermarket analysis is actually looking across different markets. If you look at the futures FCPO, you don't just look at FCP only. You also may be looking at other vegetable oils, for example, like palm oil or even soybean oil. So classical technical analysis only look at the individual chart. Okay, I repeat that. Classical technical analysis look at individual chart only. So if you trade FKLI, you just only look at FKLI. If you trade FCPO, you just look at FCP only. But in terms of modern technical analysis, when you develop further knowledge in terms of technical analysis, you are no longer actually looking at one market. You actually look at multiple different markets and see what are the relationships, how does the other market affect the current market that you are trading in. Okay, so these are the brief general overview about the classical as well as modern technical analysis. I've shared with you what are the strengths as well as weaknesses for both of them. Now, a quick summary for classical and modern TA. Classical TA, of course, it has a lot of subjective, and modern TA, it is more objective when it comes to application. So classical TA, it started from line, first drawing lines, and this is where your application of line to develop, to draw, to find out chart patterns. And then later on, people use mathematics to develop technical indicators. And then this is where your technical indicators can be backtested and go through even further quantitative analysis in terms of your trading. So these are the summary for the classical as well as modern technical analysis. Now, let's go to the third topic, which is the misconceptions and limitations of technical analysis. So, a lot of you may have a misconception or limitations about, do not understand the limitations about technical analysis, where you must, when you use technical analysis, it is actually very important for you to understand the limitations. You need to clear off all of those misconceptions so that you can actually capture the benefits as well as the advantages of technical analysis. So here would be 6 to 7 misconceptions, but you actually need to understand it first. Number one, before we enter, technical analysis does not represent everything. Okay, so I believe a lot of you may have, hear a lot or attended a lot of webinars or seminars about technical analysis, where there will be people promising you that technical analysis can do almost everything in the market. Trade every market or every product, and this is actually partially true. Okay, technical analysis cannot do everything. There are limitations towards it, and there are disadvantages as well. And don't worry about it, because some of these disadvantages you can avoid it, and you can actually use technical analysis in areas where it actually works best. So later on, I'm going to share with you how you can use technical analysis in a more advantageous way. Of course, firstly, when you learn technical analysis, you will be learning these 3 main assumptions of technical analysis. You can read through it. I will go past this very quickly. Number one is where price move in trends, because you can actually take a snapshot on this if you would want to. This is actually a very, very standard assumption of technical analysis. Number one, price move in trends. If there is no trend, you wouldn't use technical analysis at all. This is the assumption. Number two is where the users of technical analysis, they believe that the price actually reflect or reveal everything that is happening in the market. All of the news would have already reflected in the market, and there is no advantage for you to read news anymore. Okay, so this is one of the assumptions of technical analysis. And most importantly is technical analysts, those of you who believe technical analysis, you would tend to believe history tends to repeat itself. So this is where you will be using chart patterns, right? So here are the assumptions of technical analysis. Without these assumptions, technical analysis will no longer be valid. Now, let's go through what are the misconceptions here first. Now, number one and number two misconception. technical analysis, you cannot apply it into a chart or any product that has no significant trend, or if the trend is actually at a very, very tight sideways range. Okay, if you have pen and pencil, you can write this down. You cannot apply technical analysis in a market or that has no significant trend or a very, very tight sideways, or if you have a very low liquidity in that particular product or stocks. Okay, because they are very, very disadvantageous. So this chart is actually one of our stock in Malaysia. It is Nestle. So here you can see the whole chart is actually very tight range, and it's like a keyboard, a piano like that. So this kind of chart you cannot use technical analysis. So this is not ideal for technical analysis because you don't have clear trend, you have very, very low liquidity in terms of it. So don't use this for your technical analysis. However, you can use technical analysis in your futures market, because in futures market, we are fortunate that we have a very, very clear trend for example, FCPO. There's very good trend. There is also high liquidity. There is high volume traded every single day. And another example, which is our FKLI market, it also satisfies this criteria. It has a clear trend. It is highly liquid. You can buy and sell easily without having a big gap in terms of your bid ask price. You also have a high volume traded every single day. So this is where you can use technical analysis to your advantage, not every market. Now, the third misconception is that when you learn technical analysis, right, a lot of people say you don't have to read news, you don't have to look at fundamentals at all. This is partially correct only, because fundamental news, fundamental factors, it is still very, very important. Okay, so for example, this is one of the stock or one of the price that I would like to use as an example. So this for those of you who trade Malaysian stocks, probably you are familiar with this stock already. This is called MMC Corporation. It is when the price, you can see here, there is a gap out, right? And then you can see the price. How come does the price pattern is very strange and odd, where it actually moved this way? So if you just look at technical analysis, you do not know what is actually happening in the market, and you may actually trade this market, trade this particular market or this particular stock or product. So this is where if you don't read any news, you do not know what is actually happening in this chart. And in fact, for example, this what is happening in this counter or this company is that it is actually undergoing selective capital reduction, which we call SCR, or in other words, layman, we call a privatization offer by the company lah. Okay, so which is why most of the companies, if they are actually going through privatization offered by the shareholder, then you may encounter this kind of price patterns. So in short, what I would like to highlight out here is that even though you use technical analysis, you still need to consider on the fundamental factors. You still need to read what is happening in the news. Otherwise, you are actually trading very, very blindly. Okay. Now, another example on technical analysis, where this is actually a counterparty from technical analysis, where this is actually a disagreement for usage of technical analysis, which is what we call the random price movement, or in other words, we have this theory called the random walk hypothesis. It suggests that the price, all of the price, regardless of stocks, futures, or commodities, it suggests that all price move in the random manner. It has no pattern for you to analyze at all. And all of every single trading day, it actually moves independently. So this is actually where, in short, it actually suggests the price actually move according to demand and supply in the market lah. So this is a typical FCPO chart. I would like to highlight a two particular simple day for you. So example, on this particular day, 20th of September, you can see that there is a gap down on this day, and then the price travels all the way down. And this is actually a touch and go experience. If for those of you who experienced this day before or monitor this market when it actually opens, the market gaps down and then it goes all the way down for just about and stays there for about 2 to 4 minutes only. And then after that, it bounced back up very, very quickly. So this is where technical analysis is unable to explain what is this phenomena actually happening. Another example would be this particular day. You can see that it gaps up opening high, and then the whole day, the whole day price is actually a downward movement. So here you can see that price actually move just randomly for no fundamental reasons at all, because it is just based purely on the demand and supply in the market. Why price gaps up or gaps down in a particular day? There is no clear explanation in technical analysis. There is also no clear explanation in terms of finance theory or any other news. Okay, this is so far what my personal experience. Well, what we all can know is that when the price gaps up or goes up, we can say that the buyer is actually willing to pay for a higher price. That is why price gaps up. And when the price goes down or comes down, goes down, it means seller is willing to sell at a lower price and to clear their stock or want to sell out. So this is actually this is the only thing that we can explain why this happens. Any other theories or hypotheses to if you want to say big player that is influencing the market or any manipulators or syndicate influencing the market, those are not true because we are unable to prove that, correct? So on random walk is actually a counter argument for technical analysis. Another limitations on technical analysis is that you need to understand price is actually only a graphic representation of your opening, high, low, and close. And most of your indicators, in fact, all indicators are built upon these four prices: opening, high, low, and close. So here you can see the simple moving average formula, as well as a relative strength or your RSI formula. It is based on mathematics. Your mathematics, all of this formula is also based on opening, high, low, and close only. Okay, they don't use any other information to develop your indicator. So I guess many of the users of technical analysis, or many of you would think that technical analysis is very mystical, can read everything in the market, can forecast the market or predict the market. Some of you might believe that through technical analysis or technical indicators, you can read whether there is a big player in the market or whether there is people accumulating or distributing or starting to want to growing the price out. In fact, technical analysis is just formulas only. We can't see whether there is big player in the market or not. Okay, so which is why in the earlier on Eastern and Western technical analysis difference, so which is why I highly suggest you to drop off the idea of believing that there is big player behind the market, because in the Western technical analysis we don't have all of these fictional characters in the market. Okay, now the sixth one, which is on technical analysis, the trading strategies actually assume your entry and exit strategy based on your opening or your close price only. For example, on this particular day, let's say if we were to able to draw a resistance line. So let's say if you were to identify this is your particular entry point of the day. Now, my question to you here is that, which is this: are you going to enter on this particular day at just before the closing price, or are you going to enter at any price as long as it is above the resistance line, break out the resistance line, or are you going to enter once it breaks right after the resistance level? In other words, as long as it breaks the resistance level, you enter immediately, or are you going to wait for the next day opening, which is this particular day, in order to enter this particular trade? So this is where, technical analysis never mention about all of, or nothing, never mention all of these things, because technical analysis is just only technical analysis only. And what these four things that I've mentioned here, it is actually developed through technical analysis. You have your technical analysis already, you use your tools. Now how are you going to use technical analysis, which is what we call the trading strategies? How are you going to develop strategies in terms of your trading? How are you going to enter? What time are you going to enter the market? Okay, so technical analysis never mentioned about any strategies. So in terms of technical trading strategies, you still need to develop a strategy that actually fits you well. Okay. Now, one last one, which is this. On technical analysis, remember the assumption, the last assumption, technical analysis assumes we can predict history will repeat itself. But in fact, for all of us who trades, before we understand the past does not equals the future. And the market conditions will actually change the perception of the market participants. Now, for example, on this blue color area, which is what we call the resistance area, okay? So let's say we use this as a benchmark for our resistance area, and which I highlight this in the blue area. So here we can see that there are, this is what we call the condition A. At this particular time, we have condition A, and at this, but moving forward at this particular time, we have condition B. And moving forward again, there would be condition C as well. Different time, there are different news, there are different conditions as well. So this is where the buyers and sellers would see the market very differently. So if you were to use technical analysis, we are unable to gauge what is actually really happening in the market. All you are able to see is that, okay, you draw a line, support resistance line, you use your indicators, but we are still unable to know what is actually happening in the market, because there will be a lot of new upcoming latest news that is coming in the market that actually changes the perception of the market participants. So these are the 7 limitations or misconceptions of technical analysis that you need to get clear of before we are able to move on to understanding what technical analysis, how you can take advantage of technical analysis. So here is a summary. If you would like to take a quick snapshot, you can do so. These are the limitations of technical analysis. I give you a quick short while before we move to our last topic. And next slide. Okay, now, given that there are so many limitations in technical analysis, right, how are we going to solve it? Now, number one, you can actually select the right product that can use technical analysis. So earlier I've given you some examples where you cannot use technical analysis at all. It would be very, very disadvantage for you. So for you, in very lucky, especially if you were to trade futures, index futures, we have FKLI, we have commodity futures, which is the FCPO. Both have trends, both are highly liquid. You can trade this market effectively using technical analysis. Number two is that do understand that fundamental analysis, it is still very, very essential. But if you are starting to trade at your initial stage as a trader, fundamental analysis is not quite important yet. What is more important as a beginner trader is that you need to develop your trading skills. Skills like how to cut loss immediately, how to execute your trading orders correctly, and how are you going to enter and exit the market correctly without any error according to your own trading strategies and your trading systems. Fundamental analysis, it is still very important. It comes in the later part because it takes time for you to learn the knowledge in fundamental analysis, and it takes time for you to interpret the market correctly. So first develop your skills first, and then later on you can slowly develop your fundamental knowledge, because it takes time and experience also. And lastly, most important, you can actually backtest your trading strategies, because if you were to use the classical technical analysis, you are unable to backtest your trading strategies at all. But if you were to use modern technical analysis using mathematical approach, you can actually do backtesting. And next topic, I'm going to talk a little bit more about backtesting. Now, last topic, how are you going to make consistent results in trading? Now, I believe many of you have already achieved consistent results in trading, right? I believe a lot of you get consistent results in trading. However, it may not be consistent result that you are actually expecting because it is not the positive results that you want. So listen to this topic very carefully. All you need to do is actually follow these 3 steps. I give you today, because of time concern, I give you these three major steps in terms of how are you going to develop a consistent result in your trading. Now, first step is actually backtest your trading strategies. Step number 2, after you have your trading strategies, you need to follow with discipline. And after you follow your trading system, trading strategies or trading system carefully, this is where you would not have so much problem in step number 3. Okay, I repeat. If you do step 1 and step 2 correctly, if you spend a lot of time and effort doing step 1 and step 2, step 3, you will not be facing so much of a trading psychology problem. Okay, I repeat. If you do step 1 and step 2 correctly, step 3 would be very, very easy for you. You don't have so much problem in step 3. Majority of the traders or majority of you may be thinking that, I did not have a discipline to trade the market. I don't have, I'm not disciplined enough. I don't follow my trading strategies, or I have a trading psychology issue. But in fact, the issue is not trading psychology. The issue is actually step number 1 first. You need to go through step 1, step 2, then step 3 would be very easily solved. So let's go through a quick explanation on what is step 1. Now, step 1 is about backtesting your trading strategies and why backtesting is important. And what do you mean by backtesting? So let's say if you were to develop your own trading strategies, you may be creative in terms of how you want to trade the market. So this is what we call the trading idea or a trading strategy stage. So this is where you can actually use these strategies to go through backtesting, or you can use backtesting software to test out to see what is the performance of your trading strategy. Your trading strategies, whether it works well over the past 3 years, 5 years, or 10 years or not. If your current strategy does not work in the past, then why would you actually use that strategy in the future? Correct? Make sense or not? Okay, so which is why you can see backtesting is number 1 thing that actually gives you trading confidence indirectly. If a strategy is making money in the past, you can use those strategy. If the strategy is not making money in the past or make less money, you can immediately drop off those strategy. You don't have to use it anymore. You can find a better strategy that you can use moving forward. Okay, and you do not want to be disappointed after trading 5 years, 10 years down the road just to find out that your trading performance or your trading result is not the trading performance that you actually want in the initial stage. So this is why backtesting is very, very important. So when you do your backtesting, you can also understand what is the characteristic of your trading strategy or your trading system. Whether this particular trading strategy, is it aggressive? Whether is it conservative enough for you? Whether is it steady, have a steady performance or not? Or whether is it very, very volatile? And from this, you need to find a trading strategy that actually suits your personality. Of course, I understand, a lot of you, all of us, we have different personality, right? And because of differences in personality, our preference in terms of trading style might be different. So for example, if you are a conservative person, you might not want to use an aggressive strategy. It might be too risky or too scary for you. You might want to use a conservative person usually use conservative strategy. Aggressive person would generally use aggressive strategy. If you are aggressive person, if you use conservative strategy, trading might be too boring for you. So this is where you might sway and move out from your trading strategies, and later on you lose your trading discipline. So this is why trading backtesting is very, very important. So for example, here we can backtest our trading strategies. So in this chart, we are actually using, I just simply plot moving average 50 days. Now, the question for you is that, do you actually know why do you want to use moving average 50 days or not? And what is your entry and exit method for moving average 50? And how much cut loss do you actually need to do in this using this strategy? And how much initial capital that you will need to put on in your trading account to trade this particular strategy? Because a lot of people, they just copy other people's strategy without any understanding. So whenever people ask me what strategy that I use to trade, it is really hard question to answer, because although this question might be sound easy, because different indicators, they have different strategies, and it also have a different cut loss method. There is no one size fits all approach. So don't copy other people's strategy blindly. All you need to do is to develop your own trading strategies, or even if you want to copy, make sure that you understand, you backtest those strategies and understand the trading strategies and system in depth, so that you can see whether this characteristic of trading strategy suits you or not. Okay. So now that you have back-tested your trading strategy, what is next thing is that you need to follow your step 2, which is follow your trading strategies very strictly, which is you need discipline, discipline, and discipline. Not because you don't have a good trading strategies. I believe a lot of you who attended seminars or courses before are paying so much money for those trading strategies. You already have a good strategies already. And the challenge is that you may not understand your trading strategies or your trading system well enough. You don't understand it thoroughly. So if you don't understand your trading strategies well enough, this is where you don't follow your trading strategy strictly with discipline. So for example, whenever there's changes in the market or when there's volatility in the market, you tend to get panic very quickly. You doubt yourself, and then this is where you quickly switch to another strategy already. So does that sound familiar to you or not? So it's not easy to just having trading strategies. So which is why step 1 is very important. You need to test through that strategy, understand the personality of the strategy to see whether the strategy suits you or not. Then when you have all these things, you need to follow it very, very strictly. And why strictly is because when you follow this strictly, your application would be consistent and your trading results would be also consistent as well. So if you keep switching strategies here and there, no wonder your trading approach, your system might be, don't have consistency as well. Okay, can you see the relevance and the logic behind that? Now, one more thing on trading strategies, it is not because not profitable over the long run. A lot of people spend too much money on this thing and still not profitable over the long run is because of discipline. And I believe all of you have discipline. It is just like wanting to lose weight or keep fit. It is just you don't have strong enough motivation, you don't have strong enough purpose, or you don't have a strong enough reason to hold that particular trade. Okay, so this is why you cannot copy or duplicate other people's strategy blindly, because you don't have strong enough reasons to hold the particular trade or strong enough reasons to follow that particular strategy. So which is why over time, again and again, I would strongly stress that you need to understand your trading strategies very, very detailed. So a quick example, this is of course, I'm not talking about Petronas, I'm talking about on cars here. Not all cars are the same, and other than having the best racing car, right? Other than having the best car, the best engine, the best design, best tires, another important thing that to determine the race is actually the driver itself, which is you, the trader. A lot of beginners racer, they focus on the cars, the engines, the accessories, right? But they've forgotten that the main determinant of that leads you to winning is actually the driver itself. So same thing as trading, you may have the best trading strategies, you may have the best trading software, but you yourself, it is the driver for the trading. Okay, you are the trader, you are the driver. So whether do you follow your trading plan or your trading system with discipline, this is the thing that ultimately to decide whether you will be making consistent profit return or positive return in the market. Okay, so you need to focus to build on your trading discipline. Now, very quick, simple 3 ways why people don't follow discipline. You can have a quick look because I've mentioned already, people don't understand the strategies well, or even if you get the strategy correctly, but you execute it wrongly, poor execution, and you don't have confidence with your trading strategy, especially losing period. So this is all of these things, right? Especially number 1 and number 3, you can solve it in step 1 already. If you backtest your trading strategy, a lot of things has been already solved. And lastly, which is where emotions gets in the way. So this is why you don't have discipline in trading. And this is one of the famous quote from a turtle trader, the father of turtle trader. He mentioned that although he can publish his trading rule in the newspaper, nobody will still follow them because you don't understand the principles, the concepts, the knowledge behind all of those trading rules. So it is important for you to have consistency, the knowledge and understanding about those trading rules. So lastly, before I share with you how to deal with your trading psychology, and here I would like to share with you this. Left-hand side is your technical knowledge, right-hand side is your trading psychology. So on your technical knowledge, here are the things, are the technical stuff where you can actually learn, you can develop first. And if you don't develop your technical knowledge well, you can come up with a lot of trading psychology issues. So we go back to the 3 steps again. Step 1, step 2 is actually developing your technical knowledge and follow your trading strategies. Once you do this correctly, your trading psychology will not be have much of a challenges or problem at all. So how do we actually deal with our trading psychology? So number 1, even though you have trading strategies or trading strategy systems that you use, you will still need to experience the volatile market. All of us experience the same Malaysia market situation, whether it's the stock market or FCPO market. We can't avoid that. And you need to learn how to cope up with losses because all trading strategies and systems are actually focused on the long run profitability. It's not about the short run. What that means is that in the short run, you may be encountering losses here and there along the way, and depending on the market conditions as well. So you need to learn how to cope up with your emotions of losses. And of course, most of the time when traders face losses, right, they is either having a revenge trading, they no longer follow their original trading method that they already. So this is where they are out from the discipline and come up with a lot of trading psychology issues that actually are very destructive towards their trading. And thirdly, after you have do 1 and 2, you need if you have gone through stage number 1, stage number 2, this is where you are already with experience, with time, you will be developing your emotional as well as your mental fitness as a trader. So of course, it is easy to say that you want to be a trader. Everybody can claim themselves as a trader, right? Everybody can claim themselves, after attending seminar, making money once or twice, and then they say that, I want to be a full-time trader and just change job like that. But trading is we have a lot of things to do. To be a successful trader, right, it is not just measuring about how big money that you make, because we have different account size, right? But we actually measuring trading success in terms of how you are able to grow your wealth over the long run. So in short, to be a successful trader, like any other professions, like any other professionals, jobs, there are a lot of knowledge and skills you would still need to develop. You need to follow step 1, develop and backtest your trading strategies. You need to follow step 2, follow with discipline. And of course, step 3, deal with trading psychology. So trading psychology is actually not a new thing in trading. I believe in in any other professions, you has your own profession psychology as well. So for example, if you're a leader or manager in a company, there is something what we call leadership psychology or managerial psychology as well. So in trading, we call trading psychology. It's a separate set of psychology that is actually application towards in the trading area. Okay, so that's it for the 3 steps: step 1, step 2, and step 3. When you do step 1 and step 2 closely, step 1 and step 2 can solve a lot of trading psychology issues. So let's wrap up this session where I've already shared with you what are the differences between Western TA as well as Eastern TA. The classical TA and modern TA. Classical TA, it requires drawing a lot of subjectivity in there. Modern TA is using indicators, but you can apply modern TA objectively by doing backtesting. A lot of you still using modern TA in a subjective manner, so no wonder there is a lot of inconsistent in your results. You need to understand the limitations of TA, and I've already shared with you the solutions with these simple 3 steps, how to achieve a consistent positive result in your trading. Okay, so give a thought about it, how you are actually going to do your trading. You can have a quick snapshot on this particular slide, and I pass this session over to Ting Ting.